Good morning, everybody, and welcome to our latest podcast where we're going to be talking all things Amazon growth and sustainability more than anything else. I think before we kick into it, as always, a couple of quick introductions. We've got a good mix of Venture Forge staff across the room, so vendor, seller, and ads, like the Holy Trinity, I guess. Trav, come to yourself first. Give an intro.
Good to be back. Hey everyone, I'm Trav, head of vendor at Venture Forge. Been in the Amazon game probably about 7-8 years now, although it doesn't feel like it, just goes really quick. Don't know if that's a good thing or a stressful thing or just an adaptation piece. But yeah, started my career at Amazon, health and personal care, beauty, moved into pharmaceuticals after that, and now in the agency game where I head up a very talented vendor team at Venture Forge. Looking forward to today.
Awesome, thank you. Rich?
Hi, I'm Rachel. So I am the Principal Account Manager here at Venture Forge. I work on the seller team, so I work with Emma, managing and overseeing all of our seller clients. I've been working with Amazon for 8 years or so now, always agency background. So yeah, that's me.
Perfect, thank you. And then Elfie?
Hi, I'm Elfie. I'm the Principal Ads Manager here at Venture Forge, and I've been working with ads in general for about 10, 11 years now. I switched just to Amazon focus about 6 years ago, and yeah, I've been agency side since, just working in pure Amazon ads.
Perfect, thank you very much, guys. Should we kick straight into it then?
Let's do it.
So if I can come to you first, Trav, let's start right at the top of the tree. What is healthy growth on Amazon? The broadest question I could possibly ask.
Well, I think it really depends what metrics you're looking at. Obviously, you get the profitability metrics, you get the sales metrics, you get the awareness metrics. Purely from a vendor side of things, I'd say things like high confirmation rate is an indication of success. Are you able to serve the customers, get the stock there on time, get it there at the right time, order fill rates? Is your conversion rate increasing? Is that through pricing mechanisms? Is that through selection mechanisms? Is it through advertising mechanisms with new to brand? There's other pieces like glance views. Are your glance views going up? Is there more interest on your pages? And then I think ultimately is your profitability going up and is your sales going up? So there's a lot of different factors, but I'd say, yeah, if your confirmation rate's going up, you're able to serve the customer / Amazon, you're profitable and you're driving sales. Pretty good indication of success more than anything.
I reckon you could have answered that for about another hour, couldn't you?
I could.
I could have
just hashed out and keep changing it a bit.
Well, I think that kind of proves the point of what is healthy, because there's so many data points that you can look at. You've almost got death by data.
Yeah, it depends who in the business is looking at it. Obviously, senior leadership, they want growth, they want profitability, they want scalability as well. Whereas operations, they want efficiency. They want to be able to do orders in and out as quick as possible without any delays. They don't want to get any bark from more senior leadership teams. So I think it really depends who in the team is actually looking at the results, essentially.
100%. What about the ad side of things? There's probably more data available in ads.
Yeah, quite a lot. In terms of ads, I think it really has to be a balance when you're thinking about healthy growth. It can't just be growth in advertising sales and market share. You also do need to be checking that TACOS and that profitability piece. If you're growing but you're losing profit every month and every year, then that's not healthy and it's not sustainable.
100%. I think that's kind of the whole crux of the podcast, isn't it? It's profitable growth. And I think that's the danger. And I know when I talk to brands specifically, everybody seems to look at different data points. Everyone has a different metric that's important to them. Some brands, you rightly say, are focused on market share.
Yeah.
And some brands want to dominate that market. There is absolutely a cost to that.
Yeah.
Some brands are completely TACOS focused or profit focused. Everyone is so different.
As well, when you're entering quite an aggressive growth phase, you can switch these up. So you could start off by just looking at market share, just looking at advertising sales and sales going up, and then pull it back once you've got a good place in the market and focus more on profit.
Yeah. I have to agree with that. I think it's really hard to scale at a quick pace, but do it profitably. You're going to have to invest somewhere, whether it's in promotions, whether it's in pricing discounts, whether it's in new selection, whether it's heavier in ads. And obviously that erodes your bottom line at the end of the day. So it's very hard to grow revenue at a high pace and along with that profitability also. So you're going to have to sometimes choose which one you want. Are you in hyper-focus, steal market share, or do you want to be profitable and give your shareholders nice dividends at the end of the year? It's a give and take balance.
And I think this is one of the interesting things when you start to talk about peak seasons or key trading events or whatever it might be in your calendar, because there absolutely is reasons and time to drain margin. You know, if it is, and we were talking about this yesterday, weren't we, when we were with the client, there is absolutely a right time to drain that margin and just go heavy.
Yeah.
But there's also a right time to just step back and just be a bit more consistent across it. Has anybody seen any examples of that happening live with clients where they have invested heavily and they've seen return, and not seen return, but seen some really positive kind of ongoing results?
Yes and no. I think it's a seasonality thing. A few of our toy clients now, obviously Q4 is make or break for them essentially. A lot of the toys are evergreen products, but end of the day, little Johnny wants the certain toy underneath the Christmas tree and the parents are going to buy it. And obviously if you're competing on price parity, yes, pricing does come into equation, but is the product fit for purpose? Is the product filling a need, what the kid wants or the user wants or the consumer wants essentially? So yeah, it's a fine balancing act, I think, based on seasonality, based on demand, and based on the category that you're actually in.
Yeah, it often depends on the product as well. Like, is it a fast-moving product where people want to repurchase? It might then be worth taking part in an aggressive deal event because you know customers are going to come back again and again. It's not a one-off purchase.
Yeah, 100%. Is there a different approach between vendor and seller? Interesting that you sat next to each other. I can play you off now.
I'd say there's cross learnings between them, but broadly the same. Yeah.
I think something for myself which is different on vendor and seller is just how they work. So because with vendor you've got POs and you rely on POs and Amazon ordering, something I've seen that really does impact a brand's growth throughout the year is if after Q4 and after these peak periods they pull the budget back, like the advertising budget, and slow down growth. Because sometimes what people fail to remember is as we head into Q1, if you want to have sustained growth in March, April, May, you need to be keeping those orders high in January and February to trigger the POs. So you do need to kind of keep that advertising spend up and not just pull it down, say we're not in season, and then expect to kind of push more advertising spend in the short term later on.
Yeah, you're right. It's sort of like a self-fulfilling prophecy when it comes to vendor, and it kind of like, well, it does. It hurts my soul to say that with seller, you're a lot more in the driver's seat. Whereas vendor, you're reliant on POs, you're relying on your accrual terms. If you're not hitting net PPM sort of benchmarks, your VM is going to come asking you for straight payments. They're going to come ask for better cost prices. They're going to come ask for additional investments. Whereas seller, you handle all of that internally, and it's up to you to manage your own profitability. It's not really dictated by the VM or by the deals team or by price matching as much. It's pretty much dictated through your seller efficiencies.
100%.
Yeah, for sure. I think we do still see a lot of sellers who leave it until kind of last minute to prepare for these events. So I think last year was quite a good example. A lot of clients came to us maybe end of Q3, start of Q4, and then they started to think about their Q4 strategy, which, like Trav was saying, there's a lot of levers we can still pull that late into the year, but ideally that's something we need to be considering 6 months in advance.
100%. And I think when you start to talk about strategy, and we'll come on to talk about that a little bit later, of kind of when do you plan, how do you plan, and what should you be planning as well, it's an absolute massive factor. There's something you said there that's quite interesting, Elfie, and again, I know we were having this conversation quite recently with somebody, but you were talking about kind of maintaining budgets or maintaining kind of spend. Obviously, I'm guessing what you're saying is it's not necessarily about maintaining the same level of spend, it's about maintaining the same level of results. So e.g. if you have a TACOS of 10, you're not all of a sudden in an off season going to drop down to a TACOS of 5. You still have to be relevant to what's happening in that category.
Yeah, it does have to be relevant to what's happening in the category. But I would say with PPC, you pay per click. So if the market is actually dropping, then you will see a reduction in clicks and reduction in impressions and a reduction in spend naturally. If you start pulling spend out because you think I'm not in season, then you're creating that kind of artificial loop where you're pulling everything down, you're pulling the sales down.
Yeah, when there's still traffic and velocity to go after.
Yeah, for sure. There's also, I think, as we move into Q1 and Q2, just because you're not in season, it doesn't mean you can't grow. It doesn't mean you can't take market share. A lot of people like to back end all of their spend into Q4, but that's not necessarily the most strategic way to use it. For example, with toys, you can grow throughout the year if you invest throughout the year when not as many competitors will be spending.
Yeah. And do you think, well, I sort of kind of know where this answer's going, but I just need that reassurance, is like a lot of the time in Q4, products kind of sell themselves during key events. I mean, people already have a buying appetite for autumn deals, Prime Day 2.0, whatever you want to call it, Black Friday, Christmas. People already have an appetite to spend money. So are you doubling down and spending money where those sales would have already happened and you're just throwing it down a hole, or are you strategically driving it and you should rather save it maybe for like a Q2 where it's not in season, for example?
In advertising, we tend to regard it as the lead in and lead out period. So we'll have a lead in strategy and then a lead out strategy as well. So with a lead in strategy, you would think about that. With one of my clients at the moment, I was very concerned about the level of impressions we were getting and that we weren't driving a lot of brand awareness ahead of that Q4 period. So Q3 was really about kind of building everything out, building those sponsored brand videos just to get more impressions to like generate gifting ideas and things like that. So as we go into Q4, people have already seen the adverts.
Yeah.
You artificially create the demand in
Yes.
Q3 so you can harvest it in Q4 essentially.
Yeah.
100%. And we always talk a lot about off-season strategies, don't we? Go back to your point, cost per click's lower, traffic's lower. So
Yeah.
actually technically gaining ranking is cheaper in those periods.
Yeah, and that's what it is. If you can maintain that velocity from a non-peak period, whatever you want to call it, into the peak period, you keep that seller rank, you keep the overall, what's it called, stock turn essentially.
Yeah.
You know you're going to be in quite a big place, because then you can coincide that with better deals, lower discounts, more aggressive advertising. It's all just going to be a self-fulfilling prophecy.
100%. We've kind of gone down the rabbit hole of just promotional periods.
Yeah. Keep it broad.
And I guess if we flip that on its head a little bit now, then what are the warning signs you'd start to see of you've not got the right strategy?
I would definitely say market share erosion. Like if you're starting to lose market share to competitors where generally you never used to, your sales share drops down, your conversion rate drops down, your confirmation rate drops down, your impressions drop down. I'm just hitting off all the metrics here, but there are indicators and early warning signals that you can start seeing. If you can't serve, for example, if Amazon orders 100 units, but you can only serve 50 of that, you've got a 50 unit deficit that could be out of stock. That equals missed sales. That's missed seller ranks. That's additional
Cost
income
of sales that you're just not seeing.
That's it. It's opportunity cost that you've just thrown out the window.
From advertising, some of the kind of canaries in the coal mine of losing those sales velocity is definitely the impressions. So it's not a very sexy metric. No one ever likes to talk about impressions. But actually, if you start to see the reduction in impressions, reduction in share of voice, reduction in brand metrics, reduction in market share, that is a massive warning sign for what's to come. It might not have translated initially into a loss in sales, but that will come if you start pulling back.
And it's the point, it's early warning, isn't it?
Yeah.
You'll start to see it very quickly. That's one of those live metrics. Like with market share, it'll take time to almost start to drop, whereas something like that is so live and reactive that it's happening there and then, isn't it?
Yeah. I think sometimes as well, that's where people can get into trouble if they are chasing profitability, is they'll start cutting back on impressions, cutting back on clicks. They'll view it as kind of wasted spend if you've had 5 clicks and no sales. But if you do that for a long period of time, what you'll do is you'll shrink your market share and you'll end up shrinking your sales.
Yeah. A market share and sales is sort of the output of it. The input is lower conversion rates, lower impressions, lower selection. Those are the early warning symbols. And then the output of that, the negatives, is obviously lower market share, lower sales. So yeah, you need to sort of know what the inputs are that's going to drive those negative outputs essentially.
And as you rightly say, everything just has a knock-on effect then, doesn't it? If you get one thing wrong, it just tanks down that line, doesn't it? And
downstream
everything
impacts.
Absolutely. I guess, obviously, the idea of the podcast is to talk about sustainable growth and what sustainable is. And like I say, I think we've kind of rightly just jumped straight into kind of peak periods and key events and trends. But I guess if we're talking about an evergreen all year round business, what does that look like? What is a very healthy Amazon business?
I think it's one that's kind of built on trust, essentially, like that in your team. You know that your operations team can deliver on POs. You can get them into the business on time. You're not going to worry about chargebacks. You're not going to worry about PPVs, PQVs, purchase price variance, purchase quantity variance, so your catalog's in store. So if you've got like really refined catalog, you've got slick operations, you've got an engaged vendor manager or AVS, those are really good indications that you're kind of on the right path, because Amazon will be your biggest critic when it comes down to margin dilution. They'll be coming for asking for straight payments, better cost price terms, newer accruals during AVN. So there are early warning. There are early warning symbols that can sort of make or break the business essentially. And if you don't adhere to them early on, end of the year, they're going to come and they're going to bite you every single time.
What about seller business? Is it any different?
I think if we flip that question on its head, one of the red flags that I often see is an over-reliance on promotions. So
Okay.
clients that are kind of an always-on promotion strategy, and that might cycle between products, and technically year on year they might have seen growth, they might see their market share have grown as well. But if you take those promotions away, the sales kind of stagnate or drop.
Yeah.
So it's, yeah, monitoring that. You don't want to harm your bottom line, essentially. You want to keep that growing
Yeah.
strong, but what is the cost of that? Is it
Yes,
actually helping you to
100%.
grow the brand long term, or is this just a kind of short-term
Vanity exercise.
demand issue?
Yeah, 100%.
Yeah,
What ads?
that can massively impact advertising as well, just because then in ads we tend to see periods where the conversion's poor, the performance is poor, and then all of a sudden, as soon as you go on deal, it's really good. And then when that cycles, you get people that are waiting for the deals because they know
Yeah.
that the brand's on deal a lot of the time, and it can really damage your advertising.
100%. I guess if you kind of summarize that, it's almost a bit of a reset, isn't it, really? Stop, pause, reset, reassess. And I guess one of the dangers, I think you might have already started to talk about this a little bit, Elfie, is you have a really good period of growth, but then as you come out of a period of growth, you are going to level off to a degree. Doesn't mean it's a bad thing, though.
You could level off in sales, but you don't necessarily have to level off in market share. You could still be growing your market share, even in an off season or a lead out period. And there's a lot you can do, especially from seller with brand tailored promotions and kind of retargeting some of that visibility that you captured during peak periods.
Yeah.
Yeah, and I think it's constant evolution, to be honest. It's not saying that you do in isolation. It needs to be constantly refined. Like Rachel mentioned earlier, it's a 6-month cycle, it's a 12-month cycle. What have we done in the past that worked really well?
Yeah.
How can we mimic that again, and how can we actually do it better? So is that going deeper on promotions? Is it newer selection? Is it going into newer categories? Is it product exclusives to drive the margin higher? Is it better efficiency gains from a new warehouse management system that's going to allow you to service Amazon quicker? Is it better accruals? There's so many different kinds of inputs that you can put in. It just depends what type of output do you want. Do you want better operations? Do you want better sales? Do you want better terms? It really depends on what your goal is as a business, essentially, from the vendor side.
Does it come back to planning then almost?
Yeah.
Is that what we're saying?
Constant planning. I think if you aren't constantly planning for Amazon, you're basically planning to fail, essentially. Amazon will chew you up and spit you out if you're not planning. You don't come with the right data, you don't come with the right metrics, and you're not looking at the right key performance indicators that Amazon's looking at also. Your vendor lead time might be really important to you, might not really matter much to your VM, and they're just looking at pure margin. And if there's that disparity, you're never going to reach alignment because you're looking at two different things. You're comparing apples and oranges, essentially.
Yeah, 100%. How often do you reset a strategy or a process or an approach?
I was actually asked this the other day, and for myself, I think you should have a strategy for the full year and taking into account those promotional periods and really thinking about the lead in, the lead out times and kind of what your budget is for the year. So it should always be a year-long strategy, and then I'd review that every single quarter. Is it working? Are you seeing the results? What's going on? You might need to pivot. But I think sometimes the danger people run into is they have too shorter strategies, and then they'll do something for a couple of weeks. It doesn't work, and they change it up, and it's just too fast.
Yeah, I agree on that 100%. And I think the important part of that is not being afraid to challenge it and change it.
Yeah,
You can absolutely set out with the clearest, most structured roadmap for the next 12 months, and 3 months in, it's just not worked. So I think you've got to have the ability to change. And going back to your point about operational, you've got to have the operational backing to do that, because it's great going, we're going to spend so much more on advertising or do so many promo events, but if you can't back it, to what avail?
End of the day, if you can't get stock into Amazon, how can you expect customers to buy your product? That's the crux of it. Everything else just falls away if you don't even have stock in.
Yeah.
What comes first then? Stock operations or marketing?
Definitely, I'd say stock. I mean, getting stock on the ground. If you have a good repository of stock, there's demand, it's got a proven demand cycle, you can sell it, then you can market it, essentially. Sometimes you might not even need to market it. If you're the only seller on Amazon, or it's an exclusive and customers know the only place they can get it is Amazon, you might need to market it that hard, essentially, because you sort of just known to have it there. So definitely stock positioned, operational decisions have to come first.
I'd say that too. From an advertising point of view, I think a lot of people want to drive growth on Amazon, but can your stock and your lead times support that growth? And have you factored that in for the year ahead?
Yeah, 100%. And how do you align all these things then? Because there's so many different pillars that are moving and posts that are moving at the same time, isn't there? How do you do it?
I think internally you need to have alignment across the board. You need to have financial alignment, C-suite, like senior leadership alignment, account management alignment, warehouse and logistics alignment, and almost have like a little bit of a hit squad for Amazon. You know, this is the goal, this is how we want to achieve it, because you have an overarching strategy, but within that strategy, there's so many levers to hit different kinds of success. I mean, if you can get orders in quicker, you can get the sales out quicker, essentially. If you can get it in cheaper, you know, you've got better margin, that type of thing. So I think having a playbook essentially internally also works really well.
Yeah.
This is what's worked well for us in the past. This is what we know within the category, what works well. This is what we know what hasn't worked well. And you sort of bridge the delta between the two. And that's where sort of the true value lies, is the middle of what you can do good, what hasn't gone good, and how you can marry the two to sort of learn from it for the future.
I think it goes back to your point as well of not being afraid to question things. I think a lot of brands they see success and they stay in their lane, but there might be ways or small efficiencies that you can gain just by doing a quick review of who's your stock carrier, for example. How are you getting things to FBA? Can you find a cheaper deal with a different carrier? Can you source your products from elsewhere? All things like that it might end up in nothing, but it's worth questioning these things, I'd say, once a year and seeing what the market's like.
You started to talk about kind of almost back-end leakage there a little bit as well. And I think a lot of people do miss that, e.g. chargebacks, carrier shipments, etc., etc. It goes back to, I guess, the point on alignment, doesn't it? Everything has to be aligned. I guess to put it we're obviously talking about a perfect world here, an Amazon first business. Amazon is everything. And a lot of the clients that we work with, Amazon isn't a first. It's a secondary or a third channel to some of these businesses. How does that change in that world?
I think it makes it a lot harder to get buy-in and investment. It's a lot easier to sell something internally in your business if you know it works, if the numbers are great, if there's year-over-year growth, if there's opportunity for growth, if there's market share on the table that you can steal. If not, or we haven't done your homework, how do you sell it internally? How do you get the buy-in from your warehouse management team? How do you get the buy-in from finance to give you the investment for accruals, for promotions? So I think you need to have quite a close relationship internally and be your own Amazon champion, essentially, because admittedly, I think we've all dealt with businesses that hate Amazon, and Amazon is just a necessary evil nowadays. I mean, it just is. If you're not in it, you're completely out. So you might as well have a team that's all in. It's all they do. It's all they focus on, because the prize is there. It's just how you execute it.
I was going to say, obviously, I know a couple of your clients are Amazon first businesses, or very much Amazon first, but you've also got some that aren't. How do you differentiate in the planning cycle and the planning approach between that?
I think it's like Travis was saying, you've got to get buy-in from the wider team. I still see it. It's not a perfect world, but there are clients that we plan to allocate a certain amount of stock to Amazon, and then when the time comes, all of a sudden they've got to share it with eBay or Tesco or another marketplace. So you've just got to make sure you're front and center in those conversations. You're being quite strict, and you're kind of telling your clients or your colleagues, whoever it may be, the impact of not having that or deviating from that set plan.
I guess we're saying there is no difference, really. It's still the same approach, it's still the same planning, it's still the same conversations. It doesn't change, whether it's a first or a second channel to a business. Just going back to some of that operational pressures, I guess, because as you naturally start to grow and scale on Amazon, there is certain kickback, fallout from chargebacks, operations, returns. How do you plan for that? Because that's the unknown factor that you don't know.
I think you need to model it. You need to model best case scenario, and that's where the strategy comes in. It's like, do I want to grow by X amount % this year? Let's say I want to grow 30% year over year. What do I need to get to that 30%? Is it product exclusives? Do I need to sell X amount of certain products? Do I need to get certain amount of buy-in for products to sell that sort of product? So I think planning and looking at the data is the fundamental bits. You can't just look into a crystal ball and be like, oh yeah, that'll work type thing. It's all backed on data, all backed on previous experiences, and all backed essentially on what the current market conditions are. If there's no demand for a product, you can't really artificially create demand for a product. There needs to be some sort of want for it.
Let's talk about vendor seller here, because I'm guessing this is going to be a bit more of a fallout. Go to Seller World, for example, first. As a brand scales on 3P, what are the common fallouts of that?
I think this is kind of where challenger brands have the most advantage, because they have that agility to pivot a little bit more than bigger brands, and we see that often more with seller clients. Common fallouts.
For example, put it into a vendor world, you get a lot of chargebacks, don't you?
Yeah. Yeah, if your operational efficiencies aren't there, if your catalog's not looked after properly, if you're over investing in an accrual, for example, that you don't use, something like creating a vendor flex node, you're paying an X amount of accrual, but you're not actually using it. Amazon's not ordering through it. It's just wasted money, essentially.
And I guess returns are a biggest part of it, aren't they? Like, obviously, there's such different models between the two models, isn't there?
Yeah.
Yeah, for sure. Returns is a tricky one on Amazon. I think it definitely depends on the category, but there's a lot of data that you can get from Amazon now firsthand that shows what the benchmark is. So I'd always be advising clients to review where are they in comparison to that benchmark. Are their return rates higher, which you would expect in something like clothing or apparel compared to higher priced item. A TV you'd expect wouldn't have as big of a return rate. So yeah, just making sure you're in line with the market. Yeah, you'd hope.
Yeah.
Never know.
100%. And I guess if you start to get a lot of returns, obviously vendor's slightly different because you can build that into terms or however you want to model that, of course. If you start to get a lot of returns, I guess that's where the product page comes into its own, though, isn't it, as well? We haven't actually spoken about this yet. Half an hour in and we haven't.
No. I mean, I think it's one of those things, everyone knows about it, but you don't actually always take it into account. Your infographics, like, are you conveying the right information to the right customer about the right product? Is it fit for purpose? Is it not fit for purpose? So yeah, product detail page, descriptions, bullet points. You need to be able to convey and sell your product to the customer without them having to answer the questions. Also looking at reviews and ratings, the voice of the customer is super important. Do you have a commonality of a lot of negative reviews? How can you pivot and change that? Or do you have a lot of commonalities on positive reviews, and how do you double down on that also?
100%.
That's really important as well to communicate that with whoever's managing your advertising, because if a product is doing very well in terms of sales but the returns are really high, there's no point advertising it.
Yeah, absolutely. Completely agree with that. I guess what we're fundamentally saying there is you're listening to the customer, aren't you? And that PDP plays such a vital role in all of this because it's ever evolving. We talk to clients going, we did our content 12 months ago. Right?
Yeah.
A lot's changed in 12 months. As you rightly say, you've gone from a challenger brand to a market leader. The message and what you're trying to achieve has to change, surely, as part of that as well.
Oh, yeah. So seasonality comes into place. I mean, different keywords, different kinds of season, different fit for purposes. One of obviously our clients, I won't name drop, they have flasks that like keep products warm, keep products cold, and it could be an evergreen product, but like wintertime you want to keep your coffee warm, summertime you want to keep your cool drink cold. So it's all based on seasonality also, and how do you adapt keywords to that? How do you adapt marketing to that? How do you adapt visuals to that to convey the right information to your customers essentially, and have them have an informed purchase?
Do brands miss that quite a lot? It sounds really simple when you talk about it.
I think a lot of brands are getting better at it now, but I think a lot of people still treat Amazon as like a fire and forget. It's like, okay, it's there and it's good enough. You know what I mean? It's good enough. We're ticking over. We're seeing some growth, but it's the brands that really distinguish those from the ones that are like the titans in the industry. They're the ones that are looking for the next best thing. They're the ones that are doing continuous development and continuous gap filling, essentially, whether that be new product offerings, new pricing offerings. They're entering into new categories. They're giving new variations of the products. They're giving new bundles of it. They're always looking for the next best thing just to get that competitive advantage and that market share away from their competitors. So I think that's what really distinguishes like brands that are absolutely flying on Amazon versus ones that are just ticking over, essentially. And okay, that's
an always on approach, isn't it? Is that the same in ads or is it different? Obviously, search terms and trends will change, won't they, across the year?
Yeah, they do change throughout the year. And I think this is quite interesting because often they can change a long time before people think they will. For example, now I'm seeing, things come through for spring and summer when actually I wouldn't expect it to be coming through this early, but that's what people are searching for.
Yeah,
Jeez, that's quite scary when you think about it like that, isn't it?
No, it isn't. And I think the most successful brands are the ones, let's say Q4 is your main focus. You should already be planning Q2 on it. Even if you have products there, you start getting reviews, start getting rating, you start getting seller rank, you start getting sales velocity. So by the time Q4 does come around, you've got X amount of positive reviews, you've got X amount of seller rank, you've got X amount of price stabilization. You're not doing all that and scurrying, trying to get that in a peak period. You're building that up to your peak period, doubling down on it, and then there's going to be a dip on it, and then you go into the next year.
Yeah, 100%. Going back to the commercial side of it now then, how do you maintain commercial discipline across the year? We've spoken about peak periods, we've spoken about draining margin, we've spoken about gaining margin. But how do you maintain that commercial discipline across the full 12-month period?
I'd say being brutally honest with yourself and also saying no, especially from a vendor side of things. Your vendor manager and your AVS will come and ask for deal involvement in almost everything.
Yeah.
Is it a relevant category for you, i.e. back to school? Are you a product that fits well there or not really? And you have the right to say no. You don't have to say yes to everything. So commercial acuity and fit for purpose, I think, are two of the biggest things when it comes to it. Because your vendor manager, yes, they will care for you as a brand, but ultimately they care about margin, they care about growth. They don't really care about if customer A, B, C gets their products.
Yeah.
All they're seeing is numbers in the back end. All they're being KPI'd on is numbers in the back end. So I think having the commercial acuity and essential maturity also to say, no, this isn't for me at the moment, or no, I don't want to go to that level of investment, is probably a good thing that mature businesses should be doing. And don't be bullied into it if they start giving you threats of, oh, we're going to switch POs off, or we're going to suppress buy boxes. Okay, cool. Stick to your guns. You know what I mean? Unless it's something you've really driven in a negative way and you can sort of put your hand and say, okay, yeah, we made that mistake. Let's make it right. If it's something that Amazon's driven, if they chose to price match the wrong product and they come in to ask for you to fill the gap on margin, no, that was your choice to do it, unfortunately. It's going to be a hard decision. I'm not saying it's an easy decision or it's going to be an easy discussion, but you have the right to say no. It's in your best interest.
100%. Do you know what? I think it's one of my favourite questions is why. Always ask why. I think you're very good at this. I think you've got to ask why, though, haven't you?
Yeah, you do for sure.
Yeah, I mean, well, when I was at Amazon, it was called the 5 whys. You would ask, if there was a problem or a topic, you'd ask why 5 times. It's like, my sales down, why? My conversion's down, why? The seasonality is not right, why? Because it's a summer product, but it's actually in winter. Why? Because we don't have a winter product for that to fill that gap. So you asked why 5 times. Generally, by the time you get to your 5th why, you're like, okay, that's the crux and the essence of the problem.
Yeah. What are the biggest whys that I guess you've seen kind of Amazon? I know from my perspective, when I'm speaking to clients, a lot of it is modeling. Is it seller? Is it vendor? Is it hybrid? Are there any other big common ones that you guys see?
I think category expansion. Yeah, it really depends on who you are basically currently, essentially. We've got some toy brands that, yes, they work in like the plush space or they work in the child space, but then Amazon's like, can't you develop some NPD for outdoor play goods? And they're like, well, no, that's not our true business offering. And you're basically just doing something for Amazon's benefit. So I think some of the big whys is when Amazon comes and asks you for something that goes against your principles as a business, or goes against your overall vision and mission as a business. And again, that's just something to say no to. You shouldn't have to do it to appease the Amazon overlords, essentially.
100%. Anything from an ads world? Any biggies that you see people do a lot? No?
In terms of what?
Common mistakes, I guess. Maybe pitfalls that you see brands making, and you sit there and ask yourself why.
In terms of commercial,
yeah.
I'd definitely say I'd just have that long-term view of everything, like have the year-long view. If there is times when you can potentially accept a higher TACOS in a period of growth, a lower profit, but then if you expect to recoup it in market share later on, I think it's just having that really long-term view of what you're trying to achieve by the end of the year. If you get too reactive and start kind of pulling things down and tinkering all the time, you can really damage your bottom line. I think also making sure that you're looking at profit as both a percentage and a figure, because you could have a really high profit percentage, but if you're not driving the volume, you could be unprofitable.
100%. And we always say this to brands, Amazon is in a lot of cases a volume game.
Yeah, it
you
is.
have to make it work at scale in a lot of instances, don't you? Just going back to that question of why, I know from my perspective, like I say, vendor and seller is always a massive topic of debate between a lot of brands. What are the numbers and figures where you would sit there and start to ask yourself that why? Why are we not trading on this model? Why are we not trading a hybrid model? From a seller world first, I guess, what are those indicators that you start to look at and go, actually, should we be exploring a 1P model?
I think it's as you scale and you start to experience hiccups or problems with that, that's when the vendor conversation comes into the mix, and the benefits that that platform can offer to you that seller can't
Yeah.
necessarily. If you're a small business or you've not got the logistical capabilities to scale
Yeah.
to the extent that you want to, then vendor can help. And it's not as simple as that. And a lot of our clients do prefer kind of a hybrid model. That's definitely a trend that we've
I'd
seen
agree
over
with
the past 12 months. But that is nuanced in and of itself. It requires quite a specific or tailored strategy, I'd say.
What about you, Trav? What starts to spark that thought? And I guess transitioning from vendor to seller is slightly easier because anybody can do it.
Yeah. Vendor, at the end of the day, is invite only, essentially. I think, do the commercials make sense? I think that's first and foremost. Do you make more money on seller? Do you make more money on vendor? What's the effort involved to get that money? Because obviously through seller, you get a lot more invoices, you get a lot more hands-on, whereas vendor, it's a lot more hands off the wheel. You just deliver and Amazon handles the rest. I think also looking at yourself as a brand, with vendor, Amazon obviously controls a lot of the pricing. So they could not tank your business, but they can tank your brand image. If you've got unhealthy inventory levels, they will run it on discount. So if you're willing to take that knock on vendor, that might be an opportunity. Okay, well, they're running my products at 30% off, 40% off because it's aged stock. Let me move to seller because it's going to keep my brand image in place. I think also it comes down to relationships with your VM. If you've got a tough vendor manager, every year you're never good enough. They come to you with some ridiculous arson terms. They want you to do super picks. They want you to do direct fulfillment. They want you to do vendor flex nodes. They want you to do Acapulco truckloads, all those sort of things, and they're not really listening to your reason why you don't want to do it.
Yeah.
It could be a nice leverage point to get into seller and just say, look, we've got the opportunity to do seller. You're going to lose selection.
Yeah.
You're going to get hit on your KPIs. Let's have a constructive conversation of you help me, I help you, and we won't start delisting from vendor. I think also hybrid's a good opportunity to spread the risk essentially like that. Because if you're a full seller, you have to go through your know the customer essentially verification every year. Same with vendor, you have to go through terms every single year. And if you don't hit your terms agreements, they start suppressing your buy box. They start reducing your POs, which if you vendor only, that's the end of the world essentially because you can't trade. Whereas if you've got a hybrid model, you're like, cool, man. See you later. I'm going to go on seller and do that later.
Yeah.
And then obviously there's different bits and pieces when it comes through to Vine. Vine's a lot cheaper. So you can start getting products, reviews and ratings a lot cheaper, a lot easier, a lot quicker. So it's got its like pros and cons essentially. But I think mainly it comes down to the financials and the relationship piece essentially. If you don't have a productive relationship with Amazon, you don't want to deal directly with Amazon, go seller.
Yeah.
Or go hybrid.
A lot of the time it's kind of common sense as well when you would start to question that. I think we've probably spoke to 5 to 10 brands in the past year where they don't actually have a vendor manager at the minute. So they're kind of in limbo. They can't get the purchase orders through on vendor. So what are they going to do?
Yeah.
What are their options other than go to seller? And, you know, there's been loads of layoffs at Amazon just this week. So we can expect that trend to continue, really.
Yeah. And interesting coming off the back of a call of vendor accounts as well.
Yeah,
Yeah.
I think it's another 16,000 they're laying off and bringing it around 30,000 total people that they're laying off. They're going for a lot more. At my time at Amazon, they were slowly implementing, it's called hands off the wheel. So there's a lot more ticketing, a lot more offshoring. And if you had a problem, you wouldn't go to your AVS or your VM. They'd be like, okay, we'll raise a ticket for it. The offshore team will handle it. It's very hands off the wheel, which if you're investing hundreds of thousands of pounds in accruals, you don't want to hear that. You want someone that's there day and night to help you grow your business, essentially.
Do you know what? Go back to the old world as well, as Amazon was a typical buyer-seller relationship, wasn't it? You would have a point of contact. You would go for dinner. You would be treated as a true client. Whereas, as you rightly say now, it's becoming more and more stepping away, offshoring VMs, for example, rather than UK-based in most cases.
Yeah. Unless you're a massive account or you got a huge strategic value to Amazon, you don't really get onshore VMs anymore. You don't get onshore AVS anymore. Most of them is based in India or Central Europe. Central Europe, obviously, a lot better in India because you actually go see them in person, build the relationship. But someone that's halfway across the world might not have any context of who you are as a brand or what sort of weight you actually carry within that market, essentially. So it makes it a lot harder to build a business case and trust in me. I am a market leader. People do know me. you can't sell that to someone halfway across the world that's never really heard of you or
Yeah.
never interacts with your brand on the daily.
Yeah. How do you start to look at a strategy more holistically? So we've started to talk in isolation about brand tailored promotions, tacos, chargebacks, etc. When do all of those start to become too much and actually they're not working together anymore because you're trying to do too many different things at once?
I think it's when you don't have the right team that's fit for purpose. One person can't handle Amazon in its entirety. It's almost
100%.
impossible. You need a logistics team behind you. You need a talented advertising manager
Yeah.
behind you. You need a key account manager and maybe like a virtual merchandiser to help you with the graphic design, help you with the infographics. So I think if you don't have the right people behind you, or you don't have the right buy-in or level of investment within your business, that's really set up to failure, because anyone that's tried to run a multi-million-pound Amazon account on
Yeah.
their own, to do chargebacks, to do dispute management, to do ASIN creation, to
Yeah.
do all of that, it's almost impossible to do depending on the size of your catalog. A lot of our clients, they've got 500 to tens of thousands of
Yeah.
ASINs, and it's impossible to handle on a one person type thing. So I think that's an early warning sign, is you need the right team behind you to execute it.
Yeah. Do you know what? It's actually a very key point of sustaining growth, isn't it?
Yeah.
The right people in the right places at the right time to do the right jobs.
That's it. As you grow, you need to scale with
Yeah.
it, scale with it. If you growing 30% year over year, 5 years from now, you're not going to be the same business you are today. Essentially, you're going to have a wider team behind you. You're going to
100%.
have more strategic thought behind you, because you know, well, your team knows the size of the prize. They know the potential that there is on Amazon. You're not a small brand anymore.
Yeah. I guess that's another warning sign then, isn't it, really? If maybe something we spoke about earlier, of people starting to get overworked. They talk about kind of lag, burnout, things not happening as quickly as it was, reaction times, because everyone's trying to do too many things.
Yeah, too many things all at once, and you end up doing very little because
Yeah.
you're trying to fight out so many fires that you can't just really focus in on one, essentially, and tick it off, move on to the next one, tick it off.
And then while we're talking about kind of the data points and all the different kind of promo investment opportunities that you've got, how do you use that data to inform a wider strategy? And I mean, a year-long strategy. So when you're going through budgeting, how do you use that?
I think all strategies, especially with advertising, should always be data-driven and customer-focused. We shouldn't kind of assume what people want, or, you know, what the market's doing. You have to have the tools, you have to have the software to understand what is actually going on in the market, what are the top products, what are your competitors doing, and then build the strategy off the back of that software.
Yeah.
We can't just assume, oh, people don't want this product in summer, or people will use this for back to school. You don't necessarily know. We need to understand kind of what is actually going on and look at the data.
Yeah, I like it. Yeah, data first and foremost. And I think also benchmarking. Like, don't be afraid to look at who are the category leaders. What are they doing well? What offering do they have that you don't have? What pricing do they have that you don't have on sort of similar like-for-like products? What do their detail pages look like? What do their advertising strategies look like? Obviously, you can only look at it at a surface level because you don't have access to their budgets and things. But if you see them on every single detail page with aggressive advertising, you know they're probably gunning really hard for that market share. So don't be afraid to benchmark on it. People say don't compare yourself to others, but again, business, you do need to.
Yeah, I'd also, if you don't have access to software, I'd just think about utilizing what you can within the console. So, for example, the brand metrics and the look back on the brand metrics, you can understand there what's going on, not only with your conversion and your purchases and consideration and clicks and impressions. You can see the benchmark against the top performers in the category. So you can use that. You can use search term query reports. You can also use search term reports and things like that to really understand customer behavior and what's going on in the market.
Yeah, and I think also if you've got access to an AVS or a vendor manager and they are engaged, don't be afraid to ask them. They probably won't put anything on email, or they won't put anything with a paper trail. But if you have a good relationship with them, ask them on a call, ask them in person if you take them out for lunch. They might not give you exact category details, essentially like you're number one in the category, number two in the category, but they'll say you're within the top 10% of glance views in the category, you're in the top 20% of sales in the category, or you're in the higher X amount of tier of profitable accounts in the category. And then at least you know where you sort of stand, what the asks are going to be when it gets to AVN season. And it also gives you a little bit of leverage to know, okay, well, I'm actually not doing that bad, essentially. I'm not really doing as bad as I thought I am. Like, I'm top 30% within the category.
You'll always be 5% away there.
Yeah.
No, perfect. It does make complete sense, and I guess this is the whole point of the data. The data is there to drive and inform that decision, but I think having the right person in the right seat is what makes a massive difference as well, because you could absolutely switch seats around this room and none of us would have an idea.
No.
Everybody understands their own area.
I think it is because there's such different skill sets. Like for advertising, you do need more of that marketing background. You do need a very strategic mind. You need to be able to look through a lot of data and spot patterns and things like that. And it is a very, very different kind of, set of skills to operations, which is its whole, like, I wouldn't know what to do. I wouldn't be able to do anything with vendor or seller.
But I think that's something you're good at that I've seen, because you and I work on like quite a few accounts, and you're able to put yourself in the shoes of the customer essentially.
Yeah.
How are they searching for a product? It's not just keywords, it's action based essentially.
100%.
You know what I mean? Is it fit for purpose? Is it benefit led search terms? Is it benefit led keywords? So I think you're really good at that as an advertising manager. Don't worry about it. But you can put yourself in the customer's shoes, which I think is a good hallmark of a marketer essentially. You can relate to the customer of what they're looking at and inform the decision. You're not telling them what to buy, if that makes sense.
Yeah,
Are
you can
using
never
data to drive
assume-
that then, I'm guessing.
Yeah, I always look at data. So say, for example, if I was going to build out a strategy, I would always just go and look at as much data points as possible before I build out that strategy. And that's not necessarily just advertising data. Like what we were saying before, it's looking at returns rates, it's looking at profit and all these other things. It has to make, like, your advertising strategy has to make sense for the whole account. So I spend a lot of time just looking at the data and then kind of understanding what's happening and what we can do about it.
I think when you look at the data holistically, the strategy often writes itself, because you can see kind of the pitfalls or where you need to focus your efforts on for the next year or whatever time frame.
Do you know what? I'm kind of laughing as you're saying that, because I think we do see this quite a lot of it writes itself, whereas people try and rewrite it.
Yeah,
And you can overcomplicate it.
for sure. Yeah,
There's too much data at some point, isn't there? You get drowned in data, and I guess that can also have a negative impact, though, if you don't understand that data. You can see things wrong, interpret it wrong, try and almost future plan that, and you can't do that.
I think that's very true, especially when it comes to metrics that are often associated with advertising, like, for example, ROAS. ROAS is not necessarily an advertising metric, but people treat it like it is. You could have very, very good advertising, an excellent strategy, everything's in place. But if your PDP is poor, if you don't have stock, if you've lost the buy box, if all these other things are going on operationally, you are going to have a poor ROAS. So I do think it's kind of having that knowledge of what's actually impacting this ROAS. It doesn't mean that you necessarily have to pull bad keywords out, because if you fixed, for example, some of the SEO, if there's something that people aren't understanding about the product, that keyword might perform a lot better.
And I think you and I've seen it before. If a product detail page isn't converting and it's got a really low conversion rate, you can hammer in millions of pounds of advertising. All you're doing is throwing money down a well.
There's no point.
It's not going to convert
100%.
proportionately.
I think you also have to look at kind of external factors as well. So if we think back to like the COVID-19 pandemic, so many brands saw such a big boom during that period because we were all stuck at home, like home and garden furniture, for example, is a good example. Year on year, you're not able to sustain, or you're unlikely to be able to sustain that growth because there was this weird external extraneous event that impacted your sales, the demand for that product. We can't repeat that. We can't just ask all Amazon customers to come and purchase.
That did really frustrate me in 2023, because I think so many brands came out of the pandemic and they were like, right, how do we drive year-over-year growth? And it's like, well, look at the market. Look what's happening. We're no longer in a pandemic. People are outside their houses. They're not shopping on Amazon as much. The markets are all dropping, that you might not necessarily be able
100%.
to.
I think a lot of brands are only just coming out, not a lot of brands, but some brands are still coming off that high as well. They're still expecting to operate COVID or pre-COVID in some worlds, whereas Amazon isn't that today. Like we were obviously talking to a brand in the last couple of days, haven't we? And if you look at how people are reacting, like what you were doing 10 years ago isn't going to work today. You have to adapt to that. You have to change.
Yeah, and that's it. I think with COVID, well, I don't want to go back down there, but people had a lot more disposable income. They had a lot more time. You're not out and about. You're not shopping. So you're like, I will treat myself on Amazon. It's the only thing that's essentially going to come to me. You can't really go to supermarkets. You can't really do all of that. But I think even beyond that, now more present day is competition. You get B&Q, you get Debenhams, you get Hepsiburada in Europe, you get Bol in Europe. The amount of other marketplaces that are popping up is mental. It's not just Amazon anymore. Everyone's got an online sort of. It might not be as good. It might not be as SEO refined. I don't know if you've ever tried to buy on like Tesco or Sainsbury's online. Terrible experience. Like it's not there, but the opportunity is there. So if customers aren't happy with Amazon or they just need something else that might not be on Amazon, there you've lost a sale and you've gone to another marketplace essentially. So the level of competition isn't what it was where Amazon's. Don't get me wrong, it is still basically a monopoly with Amazon, but it's slowly eroding, and a lot more marketplaces are coming into the fray now, essentially offering lower prices, better selection, different kinds of sellers.
I mean, how often do you see, or do you do it as a consumer where you go to buy a product and actually you'll shop 3 or 4 different places first before you actually buy? Because you know it's so widely available.
I think especially depending on the economic situation, if you know we are in, well, we're not now, but if you are in a recession or something like that and the market isn't as good, people are going to be a lot more considered. So they're not necessarily just going to look on Amazon. They're going to look at loads of different marketplaces and find where the best price is.
And I know Amazon was on like to 2020 to about 2022 like that, but when I was roughly at Amazon, it was just scale, hammering all the selection. I want everything that you own. I want it on Amazon. Whereas now the last 2 to 3 years, they've sort of started delisting a lot of products just because it's not profitable anymore. So it was mainly focused on like sales velocity and selection, get as much in. We have every single thing on Amazon. Whereas now Amazon's kind of okay not having everything. They want the right things that are profitable, essentially. So they're limiting selection to more profitable selection, which means potentially higher prices to the customer. So maybe not as good of a deal as it used to be. And then it's all trickle-down economics, essentially.
Do you know what? It's really interesting. If you put that into a retail world, there's only so much shelf space in a retail world that you can get, and you will pay an absolute premium for that premium slot. This is where Amazon has been over the past years, where they'll just take everything because there's no limit to the amount of products you can sell on there. But actually there is, because it doesn't sell. And then warehouses get full.
And then it gets marked down because it's unhealthy stock, and then sellers aren't happy, and then your brand image goes down because Amazon's marked down 50% off. And it's just a self-fulfilling prophecy, essentially, of bad feelings.
Put yourself into that retail world. Amazon has got the biggest supermarket, the biggest shop in the world that everybody is going to at the click of a button. That's all it is. So they can't control
it's like the second biggest search engine, essentially, in the world behind Google. People go onto Amazon to basically search and price compare when they're in shops. I do it. I know I'm guilty of it. I'll see something on a shelf and I'm like, I wonder if I can get that cheaper on Amazon. I don't really need it now. I can wait a day, go and check. 50p or a pound cheap, I'll get it tomorrow, essentially. It's
people are wise to it.
Yeah, I think Amazon shoppers are definitely getting a lot smarter. I was speaking to my dad at the weekend. He was saying he's got camel, so he's been like price tracking some things that he's been watching on that he wants to purchase from Amazon, and he's waiting for it to go back down again. And
I bet it's like 10p as well, isn't it?
Yeah,
we all do it.
Some toothpaste. But yeah, I think that's a general trend that I'm seeing, that people are savvy. Shoppers are savvy.
100%.
I think that feeds back into the comments as well around promotions and running promotions too often, and also brand tailored promotions. If you use brand tailored promotions at the end of every single month, people are just going to put things in their basket and then wait till the end of the month because they know that you're going to send them a discount code.
Yeah.
The amount of brands we've spoken to recently, they've just moved to everyday low pricing. Because that is their true price point. And it works.
But sometimes that can then drive more profit, because if you increase the sales velocity enough through having the lower price, you could actually drive more volume and get more profit.
100%.
Yeah, economies of scale, especially with vendor. Like we said, it's a volume game, essentially. If you can drive that and your individual price of product cost to serve goes down, your margins essentially go up.
Yeah. Simple in theory, isn't it?
Yeah, in theory. In practicality.
On that bombshell, that brings us to the end of the episode.
Flew by.
You know? One thing I always like to do at the end of these is kind of round it up and get a top tip from everybody, based on kind of the theme of the session. So, Trav, if I could come to you first, to summarise that session, what is your one top tip that brands can use to stay consistent, sustain growth? on the platform?
I'd say be honest with yourself and do a lot of self-reflection. Even if you're a category leader, don't rest on your laurels, because challenger brands do come in. They are generally quicker to pivot on things. They are generally able to do things a lot quicker because there's less custody chain within the business, essentially. So I think be honest with yourself where you are within a category, and just keep looking out, essentially. Don't get comfortable, because there are always competitors within the Amazon space that are trying to get your market share away, whether you're a titan like a Nestle of the world, or you're a tiny little producer in the world. Just don't get comfortable. I'd say don't get comfortable on Amazon.
I'd say for myself, definitely think of your strategy and your advertising strategy. Have a year view, have a really long-term view of what you want to achieve throughout the year. Make sure if you do want to take part in a promotion, you have a good lead in and lead out strategy. And just have that kind of long-term view of Amazon and where you want to be at the end of the year.
Fantastic.
But equally be realistic with your KPIs. If you're wanting to get 50% growth year on year, what levers are you going to pull to actually achieve that? It's all right pulling numbers out of thin air, but what have you got behind the scenes that will bring that growth?
And do you know what? Mine's not massively dissimilar to that. I was going to say, know the numbers that are important to you and focus on that. Don't get sucked down into rabbit holes of things that aren't important or are just not relevant to what you're looking to achieve. Fantastic. Well, look, thank you very much, guys, for joining us. And thank you to everybody that's watching at home or has listened through to the session. As always, if anybody has any questions, please don't be afraid to reach out through the website or drop us direct messages. And we will, of course, come back to you in due course. But thank you again for your time.